we identify we're in the affordable housing business. And in my opinion, this is the best business to be in. You want to be in these affordable housing type of areas because, you know, it doesn't matter what's going on in the economy. People always want affordability. And I really like the single family play simply because you have more exit strategies. A lot of what RJ and I do, and this is really beneficial too, because like when you're dealing with private lenders, it opens the world to you. We don't just do, you know, straight up rentals. We have a lot of just straight up rentals, but what we also do is rent to own kind of thing. And then we also do what's called a land contract where, you know, we'll actually kind of like sell it to somebody else. We'll have a loan on it and then, you know, carry the paper, if you will. And then because RJ and I, in fact, we've named some of our companies low maintenance cash flow. That is like totally the name of this game. Private money allows you to do that. And you live in a great place with that, like kind of affordable housing. And really in our market, you know, it's all about the rent to value ratio. So, you know, there's a term out there because when you're buying these properties with private money and getting them fixed up, then your eventual play is probably to do the BRRRR. That's what RJ and I do quite a bit. And you know what that is, right?
Or I saw that, but I didn't know what the BRRR was. What was that?
Okay, great. So you buy it and you're buying it with private money, and the private lender, the way we're going to teach you how to do this here, Mark, is you're going to borrow 100% financing. This is going to be the key to your success. So you want to borrow 100% of the purchase price and 100% of the rehab money. Okay. And you're going to want that loan, that 100% that you're borrowing, to be 75% of the after repair value of the property or less.
I got it. So you're increasing the value with that 100% of the money, but making it 75% or less of the value, right?
Your loan's got to be 75% or less. So, you know, just to give you an example, and you're probably going to be dealing with properties slightly more expensive than this example, but just for easy numbers, you know, let's pretend you identify a property that you look at and you say, look, after this thing is fixed up, this is going to be worth $100,000.
Correct.
When you're first evaluating it, that is the after repair value. And then you're looking at it, you're like, damn, I can get this thing for 50K. So your purchase price is 50K. And then you're like, wow, the rehab is only 25,000 on it. Perfect. That's what David, RJ, we're talking about. I want to be all into this thing for 75% of that after repair value. And the reason you want to be all in for 75% or less, of course, less is always good too. But the reason these numbers, we're not just making these numbers up and pulling it out of our hat here, is because when you go to the bank to do a refinance, the bank with investors like me and you, like, and we can even, you know, once you get a deal, we can help you get this thing refinanced. There's plenty of lenders that'll do this 75% loan, but they're only going to want to come in with this 75%. They're not going to give you 100% of the value, like $100,000 loan. No bank's going to do that.
Yeah.
Okay. So this way, with that 75% that the bank's going to give you, you're going to be able to pay back all of your private money, your acquisition and your rehab property or your rehab funds.
Correct.
And now you own the property essentially for free. So, and now the bank loan is going to be a much lower monthly payment than
your
private money.
Yep.
Because it's like a 30-year mortgage now. It's pretty. So you want to be all in for 75% or less, and you want to be in this affordable housing type of area where, you know, what the bank is not going to like is a property valued at like 400,000 that only rents for like $1,200 a month. No, you want to be in areas where, you know, you can get like a good gauge or a rule of thumb is like 1%. So if this $100,000 house value, ARV, after repair value, it's going to rent for at least $1,000 a month. Go with the 1% rule and you're always going to be in the black. You know what I mean? So RJ, that's just kind of like what we do. And really it's a fail safe business here, Mark. Like, I mean, this is the safest type of plays you can make is what we're going to want you to do.
Yeah. So, I mean, the reason why a lender is going to want to be a private lender when you're presenting a deal to the private lender, they want to see, you know, how well they're hedged against risk because they're taking a chance with you. And if you can show them like, hey, this is a deal with equity, right? With equity, because you're buying it at 50K plus, and then you can lean on your experience with construction and say, I've been in construction for this many years. They're going to feel that, you know, if I'm going to give you, you know, this 75K, I know that you're going to be able to pursue and complete your strategy, which is to BRRRR, or if you wanted to sell it. So that's the whole idea. Now, in today's environment, it is good to even get better deals, because there are better deals out there. I know there's a ton of deals in Detroit, but we've been seeing deals that we could be all in for 60, 65, and 70. And when you have, you know, stuff that's going on right now, especially with the pandemic and stuff like that, you want to be a little bit more conservative to present to the lender, and they're going to feel that, hey, you're really taking good care of my money. Because a lot of these people, Mark, are just normal people like you and I. Your mom, my uncle, Dave's grandma, they have just been saving their money, and they're putting it, where else are people putting their money? Banks. And how much do banks pay? -%, 0. So they're just waiting for you to say, hey, I have a great investment opportunity. These are the numbers. They already know you're in construction. This is what I'm going to do with the deal. This is my plan. Like, you have something that they want, because right now they're not getting any return. And anybody that you present to, that's the value you're giving them, is making their, we call it lazy money, working.